Hello and welcome back. We're going to talk about the market. Nothing new there because it has been really stable the last couple of days. And I say stable in the relative context that as we see on the live chart, it has been pretty consistent with its upper and lower ranges. I'm Robert and welcome to the channel. Looking at the chart, we can clearly see that there isn't really been a lot of activity or movement. So for the lazy trading approach, it has been reasonably quiet and subdued. But it's still good money to be made. 62 cents for the last trade. But that really is the small part of the bigger picture. When you trade, you look at much bigger items, much bigger situations. Particularly, you are looking at the possibility of more than one trade, and that can be quite difficult to manage. But there is a way of doing it, and I'm going to show you how I've done it. As we can see from the current account balance, I have $972 of cash available in my account because I have quite a few trades underway. I have $647 of margin actually available, but I have used $326. We can see from the current state of my margin, I've used 16% of my total margin. Remember that the 50% mark is when the account goes into a margin call and then a margin closeout if it's not dealt with quickly. So it's a matter of being careful about your positions and juggling them appropriately. I used the lazy trading for my manual technique, but I also used some very aggressive automated trading to help capture the market when I can. This video is not necessarily going to be about the intricacies of automated trading, but rather showing the significance of the amount of work that goes into testing the market in a way that keeps the entire system from collapsing or losing your money. This really is an important part of your risk management approach. Being able to keep track of the market and being able to stay focused on the market. For example, as we can see on the screen, a lot of my trades, $1, $0.32, 92 cents for finance charges, 21 cents for a profit, 32 cents, 31 cents, 22 cents. Not a lot per position. So how does this make any money? Well, remember your account is relative to how much you deposit. I have a $1,000 baseline I use. So figure if I had $10,000, that would be multiplied by 10. So you can see how the relationship of leverage and risk play together. So let's look at the actual equity curves of several different accounts. Here we are looking at my real money account. It's not overly impressive. I took a series of stop losses in the two highlighted areas. It is what it is. You have to take the losses with the market. And then, of course, my big software failure, my database crash. But that is what it is as well. Whenever you deal with automated trading, this is always a risk. It's an added risk versus manual trading because when things go wrong, they go really wrong. Now the zero line is of course my initial budget. I always prefer to see the market this way because I can tell and test exactly how much my initial budget has been impacted by the market itself. This really is one of the more pivotal points of research, in that if you look at your market and you see the context, you actually can see a reasonable level of profitability within the account quickly and easily. You could also see how much of your original budget was impacted when something does go wrong. Now, as I said, this is my real account. Real money here, real money being lost or profited. But I have 4 other accounts on this pair, each using slightly different settings as a demo process testing different frameworks. So let's go through what I actually have done as a way of helping to protect my real money by checking different types of scenarios. So on the first account, we can see it's above water. I actually managed to stay somewhat above, but it hasn't done very well overall. A lot of this is because of over-leverage. It's also because of not taking into account volatility. There are a lot of situations that could lead to poor performance, and that really is a problem that you need to anticipate in your trading. When you look at over-leverage, over-leverage is where your position sizes are too large for the account. Every position I work with in my real account is no more than 1% of my budget. That's it. That's done deliberately to make sure I maintain control. Over-leverage is trying to be greedy and using 5% or 7% or even 10%. When the market goes in your favor, it's wonderful because it does great things. It makes money very quickly. But when the market goes against you, it decimates your account. And I'm going to show you an example of how that really took the case. Between over-leverage and volatility, the account was just ruined. But as you can see, even with a proper trading strategy, simple mistakes can be disastrous. So let's go to my favorite account of all my demo accounts. This is my favorite, not because it lost all this money, but because it demonstrates how even the best strategy can be a complete and total disaster if you don't track volatility. If you ignore volatility, your account will eventually be destroyed. Volatility is the market's way of making sure your life is miserable. It's something you can never predict. You can't plan for it. You never know when it's going to happen, and it will just train wreck your account. As we can see from here, I made close to $9,000 in this account. To lose it all when the market went against my position hard because of volatility, not planning for the market, to become unbearable is destructive. Volatility should never be underestimated. When it works for you, it is wonderful. When it works against you, it can be devastating. This is why worst case scenario planning is always so critical. This is literally a year of finding this research, of waiting for this to happen. Because if I had taken and demonstrated this account, let's say here, well, let's see. Let's say I stopped here. This looks wonderful. This looks great. This is the perfect mock-up of exactly what we want to see in the market. But it's not the truth. It doesn't show the whole picture. And this is the problem when you're testing your strategies that you have to be aware of. And this is why backtesting doesn't always work. And I've talked about that in previous videos. But you have to look at the market as a whole for long-term durations. Just because this account failed doesn't mean the strategy failed. The strategy worked perfect. My own greed in setting up this demo account, and yes, I said demo, not real money. This demo account was done deliberately to see just how long it would take before volatility destroyed it. But that is the point of demo accounts. Always use them to test. But this is an example of the perfect situation. It lost $12,000 in one volatility sweep. One market situation that just completely decimated the account. But the process, the technique that I used, works perfect if tuned properly. And that really is the true meaning in this entire video. You could have 1,000 different ways of trading, and every one of them will be profitable. But if you don't take into account volatility, if you over-leverage your account, if you get greedy, you will destroy your budget. Now, moving forward to my third account. We can see it's not as bad, it's not as good, but we can see where it has several recovery periods. But again, still, volatility and over-leverage have consequences. This one is slightly tuned to be a little better, but it still doesn't take into account a lot of circumstances that exist within the market. It didn't plan for market movement. It didn't give the market room to breathe. And that is why you see this weird pattern on the market. Why it's making money and losing money. Because when the market goes in the direction of the bot, the market goes up. When the market goes against what the bot wants, the equity goes down. This bot works great in a trending market with this setting, but it works horrible when the market is anti-trending or trading against what the bot is looking for. Common situations that exist in real trading on a daily basis. Not every strategy is good in every market. Even if it's a working strategy, it can still be bad in the wrong kind of market structure. And finally, looking at the last demo account, we can see it has a clear and present place. It did well It lost money and then it's recovering. It's a classic example of what happens in most responsible trading. This is actually part of what I use, all of this really, into making my own successful trading, my own profitable trading. All of those lessons in those demo accounts have demonstrated what I apply here. Now, I've only shown 4 demo accounts on strictly this pair, but I actually have a large array of demo accounts that I test on every single pair I can. Basically 20 different ones, all looking at market structure, all looking at the framework of how the market dynamics interplay with different settings. Some of them have done well, some of them have been equally as disastrous as what you've seen here. But the lessons are always the same. Worst case scenario planning, position size, and not being greedy. Trading can be fun. It can be wonderful, but there are risks. If you accept those risks, it can be an absolute joy to trade. I hope this gives you an insight in terms of why algorithmic trading can be so difficult and why so many people lose money in it. One of the biggest things to understand about algorithmic trading, which I demonstrated in my lazy trading, is that we see trends in the market on the screen. For example, looking at my live account real time with the positions open, we can see a clear and present uptrend right now with a slight downtrend. But the bot isn't that intelligent to spot it that quickly. It's not to say that it can't detect that type of situation, but it's nowhere near as proficient as our own brains. This is the whole point of why volatility and leverage play such a critical role. And you can even see it in looking at the spacing between each of the different positions. The wider spacing gaps, like right here, volatility was high, so the bot spread it out. But down here, volatility was low, so the bot put the positions closer together. This is just one of many examples of how well automatic trading does work and it can work. But there are examples of just how bad it can be. Automated trading is a wonderful way of capturing small profits. But before you try it, before you even think about it, take time to understand what it means to manually trade. Think about the steps necessary to actually go through and look at something in the market. What does an uptrend mean? What does a downtrend mean? And even if you look back historically, on the pair I am manually trading, we see a very flat and stable market. But we see that at any time, that market can change drastically with a volatility spike upwards and then downwards. This is really just a small picture of a very complicated problem that our brains are able to absorb quickly and easily. We have a way of being able to really capitalize on market understanding through this kind of simple analysis. But putting this into a language into a method that the machine can understand is a nightmare. It's a fun nightmare, but it's still a nightmare. So, this is the state of my trading. This is where I'm at right now in both my manual trades and my automated trades. I'm doing well, but I have to be careful of every little detail. Everything has a consequence here, and the wrong decision. If I get too greedy in my manual trades, I will blow up my account. If I haven't tuned my automated trades properly, I will blow up my account. In the rush to try to make a living trading, 95% of all people are going to lose their money because they take the wrong mindset. That's not to say that one day you might not be able to live on your trades. But realistically, that should not be the point of why you trade. Why you trade should be coffee money. Small amounts of profits that over time accumulate. That is the point. You are not going to turn $1,000 into $1 million. Not easily. This is not about getting rich quick. The only people getting rich quick are the frauds and scammers pitching that kind of rhetoric. In the real world, this is what trading is about. Longevity, consistency, and persistence. By understanding, trading isn't about large values. It's about small values. Trading isn't about big wins. It's about consistent small wins. Please hit that like button and subscribe to the video if you'd like to see more of these videos. Please help me grow this channel and help people see that trading can be both fun and enjoyable, but to also see and learn that the gimmicks that are being preached don't work. Real trading isn't about getting rich. Real trading is about building something sustainable and consistent. Please leave me a comment. Share your thoughts. Thank you for watching.